Hello, everyone. Today on the final bar, my guest is Keith Fitz-Gerald from the Fitz-Gerald Group. We're going to talk big picture, take on the overall environment. An exciting day, a volatile day. If you appreciate volatility, uncertainty, and plenty of movement and rotation, I think 2021 is probably a field day so far. Today was sort of a microcosm of that. Big move down out of the open, big recovery through the course of the day. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in these markets using the power of charting, the power of technical analysis, focusing on the message of the markets themselves. There's so many headwinds and tailwinds, or proposed headwinds and tailwinds, themes, narratives floating around. We have the Fed this week. We're in the middle of earnings. Well, we have all sorts of things, rising rates, the prospect of inflationary pressures, et cetera, et cetera, et cetera. At the end of the day, I would argue the best thing you can do, if you do one thing, is look at the message of the market themselves. Focus on the trends, identifying trends, following trends, anticipating when the trends may be exhausting. And overall, I think more often than not, that's going to point you in the right direction. We have some great guests on our show. I'm super excited to talk with Keith Fitz-Gerald later today. Tomorrow on the 24th, we have Tim Tashler from Sprott Global. On Thursday, the 25th, author and technical analyst Cliff Droke joining the show. Then next week on Tuesday, the 2nd, we're into March already. We have Jonathan Krinsky. Jonathan's a CMT and the technical analyst at Baycrest Partners in the Northeast. Let's get to our market recap. I did want to start with a poll that we have recently as a reminder. We always have a poll going on our StockCharts TV live stream, also on our YouTube channel, on social media. We're always putting polls out there to try to continue the conversation with all of you. Recently, we asked, how much time do you spend looking at charts on an average weekday? 4% of you said less than 10 minutes a day. 32% of you, 10 to 60 minutes a day. 49% of you, the plurality, the most common response, 1 to 2 hours. And 15% of you made the audacious claim that you look at more charts than I do. Which I personally find quite offensive because I look at a lot of charts. Having said that, most of us in the, we're looking at 1+ hours of charts. And, again, that is less to say that there is a right answer. It's more to think about for all of you as you respond. Think about how much time you are spending looking at charts on a given day. What charts are you looking at? How are you deciding how you're approaching that? I did an interview earlier today with Lex Lithringhausen on his Options Brew TV. Grayson Rose from the StockCharts team and I both had a great conversation with him, talked about a lot of different things that should be coming out in the next day or two. But we talked a lot about routines. Grayson Rose and I, when we chat outside of regular meetings, it's a lot about just how we're going about the process, the routines that we go through. We look at every day, every week, every month as part of that process of reviewing the investment landscape. And I'd encourage you to be thinking about that as well. Talk with others and see what their routine looks like and see how you can upgrade your own. Let's continue on with our market recap. As I mentioned, boy, what a volatile session. And the first 30 minutes had a particular look and feel to them. It certainly looked like this was a huge risk off day. All of a sudden, I'm looking at downside targets, 10, 20% lower and thinking all of this stuff. By the time I get my coffee and come and get breakfast and come and settle down a little more, it's sort of bouncing right back up. And if you look, the S&P actually finished in the positive, the Dow as well. Now, these are, two that were way down earlier in the day and just both continued higher. The Dow touched its high from yesterday's session, and the S&P almost got there. So that's a huge evolution in just one trading day. Where we continue to see weakness, it's technology, consumer discretionary, both of those finishing in the red. The NASDAQ composite finishing down about 0.5%. Mid caps and small caps, a mix, with small caps the weakest of the three. The VIX back down just below 23 today. Looking at some other asset classes very quickly, bond prices down a little bit with the TLT down just below 142. At commodities, the commodity complex overall positive. Oil prices stronger. Energy was one of the sectors certainly the positive. Earlier in the day, a very few sectors, if any, I think one or two of them were in the green, and now almost all of them finished. 8 out of 11 finished in the positive, it looks like. The DBC went up another 0.5%. Gold and silver back down. We talked about the long-term picture in gold. That's a chart we're going to look at a little bit later. But the GLD and you look at gold prices in general have pulled back pretty significantly from where they had been. That's certainly a theme to be following as it nears potential support. Cryptocurrencies got absolutely crushed today, and that really started sort of in the overnight session. You saw Bitcoin coming off pretty good, touching 49,000, rolling over again. That was yesterday, rolling over again today and accelerating to the downside. Bitcoin currently just above 48,000. That's down 11%. And most cryptos that we follow, sort of this top 10 list of liquid cryptocurrencies, down double digits, some of them over 20%. Now, that's the sort of volatility as we've talked about before. That should be a minimal expectation of looking at something like Bitcoin. If you're going into any sort of cryptocurrency on either side, you are agreeing to an excessive amount of volatility, and that should be part of it. That should be part of your risk reward assessment. I'm comfortable with this amount of fluctuation, then absolutely go after it. If not, I would be avoiding that as something that may be too volatile for many of us. Looking at a daily chart of the S&P, again, the character of this market changed so quickly. Earlier in the day, you had, in the first hour, you had stocks trade in the S&P going below this trend line. We talked about the previous trend line taking the low from October and some of these subsequent lows in December and into January. We broke through that at the end of January, came up and retested that trend line from below in February, and now rolling back. Today, we actually tested the trend line from the October low, from the January low. It's a less steep trend line, and that lined up pretty well with where we made a low today. So as we broke below that, I'm starting to think, okay, wow, these support levels might come into play a little more quickly. But what happened by the end of the day? We actually closed above yesterday's open. We closed just above yesterday's close. I think this trend line is now further validated as a pretty good assessment of the current trend now that things have settled down a little bit. And so what that means, sort of back of the envelope, we remain above that trend line. We continue to make higher highs and higher lows. The trend by definition is positive. We get below that trend line, get below the 50-day moving average. I think you have to rethink a bit about potential for further downside and where we may go from there. Today was an interesting one, balancing, obviously the comments from Powell earlier today, talking about the Fed, and certainly this expectation that the Fed will continue to summarize, do whatever it takes to keep asset prices elevated. Is the way that is the Dave Keller summary of what I heard. There's probably some nuance in there that I'm glossing over, but that's generally the message that I heard, and I know others did as well. And you can see the message that the market heard by the fact that we go higher. It doesn't change overall some of the internal weakness that we've seen. And when I'm looking at the long-term trend in stocks, I'm seeing the last 2 months higher highs in price, lower peaks in momentum. And we've talked about some of the different ways that we can think about that. Semiconductors are maybe one of the most glaring examples right now of bearish divergence of higher highs in price, lower peaks in RSI. As we've talked about many times, I think the goal of an investor, of an individual investor, in my opinion, should be 3 things. Number 1, identify trends. Number 2, follow those trends. And number 3, anticipate when the trends are exhausted. This sort of bearish divergence or a non-confirmation, depending on how you'd want to describe it, basically is higher highs in price, lower peaks in momentum. And that's more indicative of that third piece, that anticipating that the trend may be exhausted. That's a warning sign that we may be getting to the later stages of the bull market run. So for me, it's all about, are we able to hold support? We will pull back at some point, as we always do. Even in this long-term uptrend, you saw semiconductors continually pull back, pull back and have a bit of a corrective move before continuing higher. At some point, that pattern breaks, and you can tell that it's broken by the fact that we don't hold something like the 50-day, we close down through it. We don't hold the previous support level from January, we close down through it. So the semiconductor index getting below 225 would start to fit that bill of a confirmed rollover, sort of validating this bearish divergence. Until then, the trend is still higher. And again, higher highs and higher lows tells you the trend is going up, not down. And so that's something that I would certainly be paying attention to. In terms of other measures, looking at the broad market, and we'll get and hit on a couple other items very quickly before we take a break. In terms of breadth, some breadth conditions, like the percent of stocks above the 50-day diverging, lower peaks as the market goes higher. If you look at the cumulative advanced decline lines, though, really no serious signs of strength now. Now, these are not updated for today. I would imagine like the small cap advanced decline line probably took a bit of a hit today, but overall the trend is continued positive. And you've seen, again, plenty of accumulation on the participants, the members of these indexes as they've gone higher. Until that changes, that tells you, according to this form of breadth, that overall the movement has been supported by individual names. Just very briefly on some other items, as a reminder, we had energy number one, utilities number two, and utilities is one of those sectors that I think most people sort of enjoy ignoring because they're not sexy, they're not exciting, they're not a lot of stocks that you probably know, names that you deal with. But overall, these are high dividend paying stocks that are fairly defensive and tend to hold up pretty well when the market's getting choppy. Utilities have pulled back to support. I think it's an interesting one to see what happens here if we get further instability in other sectors. As a reminder, tech, consumer discretionary, the two weakest of the S&P sectors, both giving back some of the recent gains that they've had up until now. We need to take a quick commercial break. We'll be back with my guest, Keith Fitz-Gerald. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So thankful you're able to join us every weekday after the close as we look at the markets together using the power of stock charts, using data visualization and technical analysis to try to make sense of things together. As a reminder, we're going to do another mailbag segment a little later in today's show. We'd love to answer your question in our next mailbag segment at the end of this week on Friday's show. You can get your questions to us a couple different ways via email, thefinalbar@stockcharts.com. on Twitter @FinalBarSCTV, or on our YouTube channel. Just put a comment right below the video that you're watching. We'd love to answer one of your questions on the air. Also, as a reminder, we're just this week releasing our new Stock Charts TV on demand. Go to StockChartsTV.com, or on any of the app stores, you'll see the Stock Charts TV logo and app. It is free to sign up, put in your email, and you can access all of our videos whenever and wherever you like. I want to welcome on my guest, Keith Fitz-Gerald. Keith is with the Fitz-Gerald Group here in the Seattle area. We had a fantastic conversation, Keith, recently as we were talking about sort of our investment processes and how we deal at the end of the year. Really enjoyed your thoughts there, and welcome to the show today.
Thank you very much for having me back. It's a real pleasure. Appreciate it.
So Keith, obviously quite a volatile day. It was a fascinating day. I feel like among many fascinating days with plenty of movement. We're in the middle of earnings. We have the Fed. We have, a market that has had an incredible run, and now this rotation that we're in. Start us with the S&P 500. Talk us through what you're seeing and thinking here.
Well, I personally love days like this because, technical analysis, the thing that's really cool about technical analysis in my world and the way I look at the numbers is that they tell a story. The problem most people have is they, A, don't want to believe what their eyes are telling them, or B, they don't want to believe what they're experiencing. And, again, I come from a school of hard knocks on this stuff, and the numbers will tell you dang near everything you need to know if you understand the background. And this chart's a good example, the S&P 500. We came into today with a massive bout of selling. And, as I noted on Fox Business this morning, that was absolutely thematic. That was deleveraging. That was a number of order flows that had built up. The market seemed to like Jay Powell's comments, but, to the point I made with Neil Cavuto, you can't overcome the mechanics of the markets. The buying simply got to go until the computers say stop. What's interesting to me, though, is if you take a look at the Bollinger Bands and the Kellner Bands, this is where I start my day, or some variation of this using the proprietary tools we have. What I'm concerned about is how does this look with volatility around price, which is Bollinger, or volatility around trend, which is Kellner. And this should be around 20, 21 days most of the time. Sometimes that varies based on cycle. But you'll notice, even as massive as the downdraft was today, we didn't break, to your point, some of the key support levels. And we didn't break outside of either of those measures of volatility, which is a logical explanation to me of why the markets are working the way they should. There's buying and selling. So I took that as a huge sign of affirmation. Fundamentally speaking, if I'm a techno fundamentalist, we've got an accommodative central banking system around the world. We've got vaccines rolling out, and we got millions and millions and millions of people who simply want to get out. So I think we're going to have an explosion in economic activity. The trading that we saw today is consistent with that. The uptrend is consistent with that, and the volatility around trend is consistent with that.
It's a great point, and I think you hit on it, Keith, right? I mean, we sold off today, but we didn't violate any key levels. And I think from this chart, looking at some measures of volatility bands in different ways, we held up pretty well. What do you make of this general rotation that we've had, right? I mean, I think one of the big defining characteristics of the last, maybe 2021 so far has been this rotation away from the FANG mag sort of stocks, the technology consumer names, into things like energy and financials. Is that the beginning of something further that you're seeing, or is this just a mean reversion before some of the technology names we've gotten so used to at the top of the leaderboard sort of regain their footing? How do you think of that rotation?
Well, I'm more in the latter camp, Dave. I mean, knowing what I know about institutional programming, because I've done a lot of it in my career, they are very much driven by mean reversion. They are also very much driven by the concept of barbelling. So this idea that the money's rotating in or out or from and to various sectors really is a non-starter in the headlines. And when you talk to the actual mechanics behind the scenes, the market's never leaving the system. Money's never going out of the system. What's happening is the institutions are rotating into stuff that's undervalued, and they're just constantly ratcheting that up. And so it's not a matter of exits, it's a matter of balance. And we're very much in that philosophy. So I think FANGs are not only coming back, but I think any investor that sold out of the big tech today or got carried out because they hit their stops has got one heck of a problem on their hands, because the question is not what happens in the next 24 hours. The question is, where do you sit in 5 years if you don't own these things and you don't get back in them? I think, the last place you want to be, Dave, frankly, is kicking yourself in the butt because you got rid of Apple, or you got rid of Tesla, or you got rid of Palantir, or any of the other big names that got hit today.
Mm. It's such a fascinating comment. I love you imply this issue that I think a lot of investors have, and we only have about 30 seconds of overreacting to short-term movements like what we saw today, and forgetting to focus on the long-term trends and where they have. Just very briefly, I mean, what guidance or what suggestion, what tips can you give to people to minimize the chance of that happening and focus more on the long term?
Well, number one, understand the person looking out from you in the mirror, because that's the biggest single impediment you have to making money. And if you got a problem with the person looking out in the mirror, you're never going to make money consistently. But the second thing is, on big days like today, remember how the game's played: buy low, sell high. Most people fear corrections and down days because they're not prepared, Dave. They don't fear them because they're stupid. They fear them because they're simply not prepared. So if you handle that, if you get prepared, you get low ball orders, you understand how to sell cash secured puts, you know exactly which companies you're going to buy if you get the chance at low. Days like today are a Viking and an all-you-can-eat buffet, and that's a good thing.
That's a great place to leave it. Keith, it's so great to have you back on the show. Thanks for giving us some time talking through your perspective. Hope those around you stay safe. We'll talk to you again soon.
Thanks, you as well. Appreciate it.
That's Keith Fitz-Gerald from the Fitz-Gerald Group. I love his comments at the end about really thinking about the voice inside your head. It's often the most critical voice you will hear anywhere is not someone else's. It's the voice you have inside your head. And what I found, to echo Keith's comments, the successful investors that I've been able to work with over time, I find they have great self-awareness. They know who they are as a person, as an investor, and they make decisions. They focus on their strengths, and they surround themselves with resources and people and routines to help address their potential weaknesses. Great take right there from Keith Fitz-Gerald. Let's continue on with our show. We will go to the final bar mailbag. As a reminder, no questions are out of bounds in terms of what we can address. We'll do our best to point you in the right direction. Shoot your questions to us anytime via email, thefinalbar@stockcharts.com. We'll hope to answer one of your questions on the air in our next segment. First question, Dave, I have no problem understanding each individual component of the market at the macro level, but for some reason, I don't know how to put it all together. Can you help me develop a sort of one thing causes the next framework, one that could help light the way as I proceed to the top-down analysis? So, we've talked about this in different forms before, and I would just say, it is easy to want to oversimplify. And I remember sitting down for my CMT exams a couple years ago and writing on the top of a page, just thinking about different formulas and stuff that I would need to know for different indicators and different things. And I remember sketching out a simple relationship between the dollar and commodities and interest rates and stocks, and just having that in front of me just to think about the relationship. And in some ways that was helpful to try to simplify those relationships. But in the other hand, what I have found from the moment I took those exams and have put these tools into practice day to day, week to week, month to month, year to year, thinking of those relationships in too simple of terms are very difficult. So, and Bob Prechter has echoed this in a number of times, my conversations with him about, looking at something like stocks and gold. We tend to think of gold as a safe haven. So when stocks start to sort of correct, you look for something like gold as a place to park and ride things out. But there are plenty of times when those things move together to the upside, to the downside. There are plenty of times when they do not move together at all. And there's a strong negative correlation or even no relationship between the two. So as much as I would love to tell you there is a formula you just need to follow, I think that's very difficult. What I would encourage you to do as an alternative to that is focus on a good routine that you can follow to analyze those charts and get a sense of them. I do two things to try to do that. One, I often refer to the market trend model. This is the weekly model that I show. We look at it on the S&P for, my clients, we actually look at this for a bunch of different asset classes, for different equity styles and cap tiers, for different global markets, for commodities, currencies. You can run that same sort of methodology. So I'd encourage you to do that. And then also have chart lists set up. We're able to review and identify movements, inflection points, and rotation. Just make sure you stay on top of things and look at how those relationships are relatively fluid. Next question, marijuana stocks are getting smoked. And I love what you did with that sentence. If Bitcoin collapses, things will get interesting. How much longer can stocks defy the contradiction of falling corporate bonds? Really good question. And I think you're right. I mean, if you look at things like, like Podex comes to mind, or Tilray. Podex is probably a good illustration of this, this incredible rally in the cannabis trade, and then the complete halving of those of the products in about 2 weeks. These were part of those that group of names and ETFs that were caught up in a pretty aggressive up move and then have sort of unwound a little bit. Interesting bounce today, gapping lower, but closing more at the highs of the day. It's a bit of a hammer pattern. I'm curious if that's going to bounce higher as you would normally expect if you know your candlestick analysis. But having said that, you're right. We're having some of these trades that had been going vertical are coming off. Cryptocurrencies as well coming off. And you talked about the contradiction of falling corporate bonds. So right, and I think what you have to remember is rising yields in general. In this short term, I tend to think of it as positive for stocks, especially when rates are still low, because it's a sign of a healthy economy that things are expanding. It's certainly good for financials and some of those more value-oriented plays. Eventually, though, rising rates tend to be a problem because it tends to hit the consumer, it tends to hit companies in ways that are less than ideal, and it ends up being more of a headwind. But in the short term, it tends to be a tailwind, which is why you've seen the market able to rally on higher rates. At some point, I think you're absolutely right in that. The question is how high. We're still relatively low in terms of interest rates than we have been for quite a while. Next question, where can I find stocks making new highs and new lows? Simple question, I love it. Couple ways you can do it on our platform. Our scanning engine comes to mind. What I would probably do though is use ACP now. ACP, and I love having this as an option of something that you can go to for this. So when you bring up StockCharts ACP, on the right side you have this toolbar, and a lot of these will hold scans and things like that. There's a scan I was actually running earlier today. S&P 13-week high. So when you bring this up for the first time, it's going to look like this. We have predefined scans, and you'll see things like new 52-week highs and new 52-week lows. Any scans that you build in our scan workbench, there's a link there at the bottom, you can go to as well. So I regularly review stocks making new 13-week highs and 13-week lows in the S&P. You can actually bring that up, run the scan, and you can see the results real time in your screen. And then you can actually click through and then just hit the arrow key and go through all these charts. Here I'm looking at a weekly chart, a daily chart, and a 5-minute chart all linked together. It's an easy way to do that. Coincidentally, you can also look at, what was I going to say? The scooter rankings. You can see stocks, big gainers, big losers, which is part of the market movers. One, the little light bulb, the little trophy is using our scooter rankings. So you can see which stocks are rated the best based on that proprietary methodology we've developed, that percentile ranking system. So there's a lot of ways to bring lists of names that are moving into ACP, and that's the way that I would review them. Last question, then we have to be done. Why is the PE ratio of FCX so much higher than those other global mining stocks? That is so beyond the scope of what I can answer in 30 seconds, but I'll do my best, right? So when you're looking at FCX, remember when you're looking at PE, so if I'm looking at the PE ratio here, which is pretty high, remember there are two parts of the PE. There's the P at the top, which is price. There's the E at the bottom, which is earnings. So if this is going up, if the valuations are going higher and higher, that means one of two things most likely. Price is going up, earnings are going down. That's the way that numerator gets bigger relative to the denominator. So if you look at other things like, I don't know, I'm thinking of a random thing like a Newmont Mining, the valuation is going to be a lot lower. A lot of these, the price has just not been anywhere near as good. So the PE has gone up for a lot of stocks that have had good runs just because the price has gone higher and higher. So basically you're paying more for the earnings that the company is able to generate. A lot of mining stocks have not had great price runs, so their valuations remain relatively low. Maybe a topic for another segment down the road, but we need to wrap the show. 3 charts in 3 minutes, that 3 and 3. Here we go. Chart number 1 is this one, the S&P with a percent of stocks above their 50-day moving average. That's the green line here at the bottom. Here's price at the top. Here's the breadth indicator at the bottom. I've mentioned the fact that we have some bearish divergences with breadth. We have prices going higher. We have this breadth indicator going lower. And what that tells you is every time the S&P goes higher, there are less and less stocks that are participating in that up move. It's interesting to think of this breadth divergence relative to what Keith Fitz-Gerald was talking about earlier today. You've seen big growthy names pulling back. You've seen the FANG trade easing off. His argument is this is the building momentum for another move higher. He could absolutely be right. And my projection for the year was closing 2021 higher than what we started. I think it's going to be a choppy experience between here and there. And I think that's what breadth indicators like this are starting to tell me is probably going to be the key. Chart number 2 is the semiconductor index, the SMH. We talked about this earlier. And again, the bearish divergences I'm seeing on price, the SMH may be one of the most telling. But again, as long as we remain above an ascending 50-day moving average, things are fine. As long as we remain above 225, which would be its swing low from January, things are fine. We start to break those, you will hear my tone get a little more measured, a little more negative as we think about further downside potential because of increased downside risk. Finally, the third and the 3 and 3 is a messy look at the gold ETF GLD. And I'm sorry I wasn't able to clean this up further. I don't like having this many lines where it just looks like a jumble of stuff. But the line I'd love for you to focus on is this blue line. This is a trend line coming off the August high, connecting with the November high. We broke above it, which was a failed breakout at the beginning of the year. We've then continued to track this trend line. And I think that's still a good measure of this downtrend. Gold, the GLD has now retraced 50% of the March low to the August peak. I think we're in that sweet spot where if gold overall is going to be a constructive trend, which I think it is, we're nearing that point where you may expect a tactical bottom. Folks, that is our show for today. Thanks so much for joining us every weekday for the Final Bar. Special thank you to my guest, Keith Fitz-Gerald, joining us from the Seattle area, sharing his thoughts. Check out our new app, StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.